Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We're mortgage brokers and buyers agents working with clients all over Australia build property portfolios. In this episode, we talk about how lenders take your income, liabilities, and your expenses. We also talk about lender policy with low-rate lenders versus actually making lender policy work for you. We also talk about strategic lender selection to build your property portfolio as you expand your wealth through property.
So understanding your borrowing capacity and what it's made up of. So your borrowing capacity is actually comprised of your income, your liabilities, and your living expenses. And when it comes to income, you might be a PAYG employee or you might be self-employed. And when it comes to PAYG, you have different components of income being your base salary. Then there is bonus income, overtime, allowances, etc. Depending on the lenders you're going to, the income that you end up using could make a difference to what your borrowing capacity ends up being.
And lenders are also looking at if you're an essential services worker or if you're working in the health industry, for example, you might have salary packaging and some tax-free income as well. But going back to the extra income someone gets, right? The bonus income or commission income, lenders are typically shading that income. They're also looking at with bonuses last 2 years of income, and with commissions, they might be looking anywhere on 6 to 12 months of income received. It's very much policy driven as to how much income a lender uses. So for example, you might be in a new job, first year in a new job and received bonus only once. And what that means is not all lenders would take it, and your borrowing capacity would really vary between what you might get with lender A versus lender B.
So it varies, right? Like just talking about bonus income, there's so much variation. Some lenders would actually average out the last 2 years. Others would take lower of the 2 years. And then there's some lenders who would take the latest financial year. So it's about navigating the different policies that the lenders have to maximize your borrowing capacity.
Yeah, well, I was reviewing a client strategy the other day, and they've only just received one bonus in their current job, and their borrowing capacity is starkly different between the two lenders. You know, a lender which averages 2 years, they may only be able to borrow 400 grand, as opposed to a lender which takes their full bonus, of course, shaded to 80%. But the latest bonus, they can borrow anywhere around $600,000. So it makes a difference between the quality of property you're able to buy. People often think that all lenders are the same, but each lender is treating income differently. And as I referred to around the tax-free income side of things, that also helps your borrowing capacity, and not all lenders would take that.
That's right. So if you are working for a not-for-profit organization or you are working in the health industry, that's where some lenders would actually specify how much tax-free income they would take, and they would say, okay, we won't take more than, say, about $16,000 to $18,000, where some other lenders don't even have any limits on how much tax-free income they would take. So it could really help improve your borrowing capacity. So just walking to your bank, for example, you might be with a bank and then you might just ask them for the borrowing capacity. However, if you looked at a whole heap of options, then you may be able to actually achieve your goals faster and easier.
Well, there's also then commission income, right? There's a big difference between a lender annualizing your 6 months of commissions versus 12 months. So often people think loans are just about the interest rate, when in fact it's about what you're able to maximize with the opportunity that you have with a specific lender. And on the other hand, if you were self-employed, right, most lenders are looking at least 2 years ABN and looking at last 2 years of tax returns.
And there are some instances where you may be able to look at 18 months of ABN. And also some lenders would also allow you to take the latest financial year. So say you started the business 2 years ago, exactly 2 years ago, and you only have 2020 3 financials available. You're yet to do your 2024 financials because we just finished 2024 financial year. Then some lenders are okay to take the 2023 tax returns for you to be able to service for that loan. And there are some lenders who may also even look at 18 months of ABN. Obviously, there are some restrictions around it. So you need to consider each lender policy to be able to maximize your borrowing capacity.
And I'd say we also need to consider probation as well, right? When it comes to which lender will take your income or not. Many lenders, especially in the lender's mortgage insurance territory, want you to have completed your probation. But then there's lenders who will rely on just your latest payslip as well.
I think with that, what's important is looking at how long have you been in the industry and did you have any gaps from your previous employment? Because if you are in the same industry and you've transitioned from one role to the next, then you may be okay being in probation, and many lenders would actually take that. And another thing to really consider there is if you're paying lender's mortgage insurance, because not all banks will be okay with you being in probation and paying lender's mortgage insurance.
And then that brings me to casual income. Most lenders want you to have done the role for 6 months to be able to annualize that income as well. So, or if you have just changed jobs, perhaps if you have been consistently in a casual role, then there would be a few lenders who would consider that. So casual income is another one. And
contracts. Yeah. And, we see that a lot with IT professionals, right? Going from one contract to another, And I've also had instances where people have been in a PAYG role, in a contracting role through an agency, and then they've changed it to self-employed income. So they've set up a PTY Limited and they've transitioned their contract that they had through the agency through to their own entity. We've been able to actually get their loan approvals, even though they're now self-employed and the ABNs have been less than 2 years old. So there are some instances. So it's about selling that to a lender and providing your history, your career and what you've done over time. And we've had success with that as well.
Then there's contracts where you're working through a recruitment agency. Like you might be contracting directly with an employer, or you might be contracting through a recruitment agency. What many people don't realize is when you're contracting through a recruitment agency, that's exactly the same as casual employment. And again, banks are looking at 6 months of salary deposits or pay slips to consider that. But if you were contracting directly with an employer, that could be, under many circumstances, considered just same as PAYG income, regular income. So every lender is different in terms of what they take. Sometimes it's also about getting an exception from a lender, right? Your income might be very unique.
Yeah, so it's about talking to the lender, and that's what we tend to do, like having a scenario and running it past the lender, providing them with a story around what your circumstances look like. So there's no hard and fast rule that they would decline the deal. So they may be comfortable doing the deal. So you may be fortunate, like you just have to run that past the lenders.
Then it comes to your liabilities, right? The banks are looking at your credit cards, any car leases, novated leases, car loans, personal loans, HELP or HEX debt that we have in Australia, and also looking at Zip Pay, right? That's a new one.
Yeah, that's right. These buy now, pay later facilities are relatively new in the last few years. So it varies lender to lender how they would treat it. Some lenders would just treat it as part of your basic living expenses, whereas others would require you to include that as an ongoing credit card liability there. And when it comes to credit cards, what we regularly hear from our clients is, well, I'm not really using it, or I pay it in full every month. So why is it impacting my borrowing capacity? So regardless of that, right, if you have a credit limit, you have access to it and you can utilize it. So lenders are typically taking approximately 4% of that as your ongoing monthly repayment. So if you have a 10 grand card.
Yeah, that's like $400 per month in commitment every single month. And that can substantially reduce your borrowing capacity the more credit cards you have.
Yep. And then it comes to your existing lending. So you might have taken out some mortgages a while back. those loan terms would have reduced by now. So depending on what the loan term is, it will impact your borrowing capacity.
So if you have, say, you've had your home loan for 10 years with a lender, the banks are saying, well, you only have 20-year term remaining, and that influences your borrowing capacity. So more often than not, to improve borrowing capacity, you do have to internally refinance or refinance to a lender back to a 30-year term. And that's not to encourage you to take another 30 years to pay it off. You should still continue building off your offset account at the same pace, but it helps improve your borrowing capacity. And then there's investment loans that are interest only. So banks are looking, let's say you have a 5-year interest only term and 25-year principal and interest term. That means the banks are looking at 25 years worth of repayments. That impacts your borrowing capacity for the worse.
That's right. And also when people are getting some tax-free income, they might have some deductions, right? Like admin fees or some processing fees for their tax-free income. That figure is also taken as ongoing commitment at times.
Liability.
If it can't be stopped, as a liability.
I think what people don't realize is that with investment lending, lenders are also giving you negative gearing benefits. So any tax benefits you might receive. So let's say you're paying 7% in interest rate. The banks on their calculators allow you to negatively gear or apply tax deductibility to those loans right on the lending. And that helps improve your borrowing capacity overall. So when you have investment lending, that's another factor to consider.
And another thing that we see is employer share equity. So you might be purchasing your employer shares. So depending on whether you're able to close that or stop that purchase at any point in time, then lenders will ignore it. But if you tell the lender that, well, you can only really stop it at a certain point in time during the course of the year, and you can't just stop it at any time, then it's actually taken as an ongoing liability. And then there's voluntary super contributions. Yes. As long as you can stop those at any point in time, then lenders will ignore it. If you can't stop it at any point in time, then it will be taken as a liability.
Yeah. And then there's living expenses. That's been a big thing over the last several years with how lenders are taking living expenses. So living expenses are divided between basic living expenses and additional living expenses. Basic expenses could be like groceries, right? And utilities bills.
And your primary residence costs, childcare, basic medical expenses.
Entertainment, things like basic
or
expenses.
Transport costs.
But lenders are also looking at what your income is and what your family size is to also determine your living expenses based on household expenditure measure, which is the HEM. So you might say you spend $5,000 a month, but if the bank thinks your living expenses for your circumstances are $6,000, they will override it.
That's right. Yeah. So we have obviously these conversations with clients where they're like, well, I don't really spend that much. So it's actually inaccurate figure. But regardless of that, lenders override that. And then we have additional expenses. So additional expenses are over and above your basic expenses. And it generally includes things like your private health insurance, trauma and life insurances. One that we now quite regularly see in the more recent years is private school fees. And these all impact your borrowing capacity. So say hypothetically, the $5,000 that you believe are your living expenses, and it includes your private health insurance.
School fees.
And school fees or whatever the case may be. But what the lender will do is they'll say, no, actually, based on our calculator, your basic expenses should be $6,000 plus all these additional items. You're going to take it over and above your basic expenses. So it's a worse impact on your borrowing capacity.
But that's also lender policy driven, right? Because then actually, just to add to this, there's investment property expenses that banks are now looking at adding on top of your basic expenses. But depending on the lender, they might include your health insurance or your investment property expenses as part of your basic expenses, which again, very much policy driven, lender driven, and can help borrowing capacity with one lender versus the another. And that again drives home the point, not all banks are made equal.
That's right. So it's about navigating policy overall, whether it's to do with your income, liabilities, or expenses, working through those aspects to be able to see where am I able to maximize, where am I able to achieve my goals and build my property portfolio.
Well, that's where people don't realize, right? It's not only about the interest rate, the lowest interest rate. People keep focusing on, well, thinking that all banks are equal and what's the lowest rate would I get? But there's more behind the curtain. There's more to the picture, more to the story.
But the industry is transactional, right? And most people compare based on rates because that's all they can see. But there's so much more. It could also go down to, we could look at, the product level. One product may work better for you versus other. Or sorry, the structure of the loan may work better for your goals versus not working for your goals. So you need to really look at it in line with your long-term goals.
So it's really about maximizing that opportunity available to you, especially if you're building and expanding that portfolio, moving from one property to the next and the one after that. And people, if all you're looking at one product, one policy, one interest rate, that's all you're going to get. And look, for lowest rate, you just go to an online lender. If that's all your goal is and you don't want to expand, that's okay.
And there's a massive opportunity cost, right, of not exploring what your potential is. You may just be able to see what's in front of you, that this is my bank. And for convenience reasons, you might just go to that one bank and want to stick to that one bank. Like I was having a conversation with someone recently and they said, we were talking and they said, well, I've spoken to my lender and my bank where my mortgage is, and they have indicated that I could borrow $500,000. And there was no consideration of, the overall structure in that. There was no consideration of what this individual could do. And they wanted to buy a property for a certain amount, like within that 500K, including purchase costs. But they wanted to target, say, capital cities. And I was like, well, are you able to actually maximize what your potential is by just sticking to that? Have you explored policies or have you explored what the potential is? So it's an opportunity cost. It could make a difference in being able to buy a quality asset or not being able to buy a quality asset and missing out on potential growth and missing out on being able to expand your portfolio.
Yeah, well, the industry is designed to just focus on the rate rather than structure of the loan, how to correctly set up your loans to maximize that opportunity so you can pay off your home loan, owner-occupied loan fast, and then also save tax on your investment properties and minimize risk as you go along. We review portfolios, right, that come across our desk where the banker or even brokers have just tied the loans together. How do you make sure it's set up correctly? How do you maximize that equity?
So we've spoken about your income, how lenders take your income, your liabilities, and your expenses. And we've also touched on lender policy versus having a low rate. So you may have an amazing interest rate, but you might have a very terrible product that you're working with, which doesn't tie in with your goals or it doesn't serve you.
Well, let's look at basic loans, right? Like I was reviewing numbers for a client and they were on a basic product, which means they had no offset and they had like sub 500,000 loan and they had maybe 150K in savings, and the savings were spread across different bank accounts, different banks, not even in the redraw of that loan. So the reverse compounding effect to pay off their home was not in place. Two, they had zero flexibility to create loan splits or debt recycle their savings tax effectively to their advantage and to invest further. And then it comes to how's the lender with releasing equity, right? That's an important one if you're building a property portfolio.
So access to equity is important because that's what fuels a property portfolio. So you may be with a lender with terrible policy around equity cash outs, which we will be covering off at a later point. We'll talk more about it. But the idea is that you want maximum flexibility to be able to make the most of your resources or your equity that you have to build wealth through property.
Yeah, because there's lenders who will release unlimited cash out, right? And then there's lenders who will control what you're able to do. So if you can't expand that portfolio, sure, you have a great interest rate today. You might save a couple of $100, but look at that opportunity cost to being able to build a portfolio.
That could run into hundreds of thousands of dollars of missing out on capital growth by choosing the wrong lender.
Yeah, and the difference between being able to afford another, say, $700K property with 10% capital growth, which is 70 grand per annum and compounding, versus saving a few basis points. So it's a real mindset shift when it comes to building a property portfolio.
Well, one of my clients, I recently restructured their loans. I've been working with them for a good part of the last 7.5 years. And they've expanded that portfolio over time. And we restructured and refinanced to a lender just purely based on policy. Even though the interest rate went up for their owner-occupied lending, they were able to tap into the equity. They were able to free up borrowing capacity. And now they're going to be buying their next investment property soon. The difference in, saving a few basis points in interest could have meant that they would have missed out on potential future growth. Now they'll be able to potentially purchase a property worth anywhere from $600,000 to $700,000. Say that property grows up by 10%, they make $60,000 to $70,000 in comparison to saving a few basis points by staying with their existing lender.
Well, in this case, they paid a few basis points, but there's also mindset where people say, well, I want to keep that credit card, or I want to keep that car lease because of the tax savings, but the compounding growth completely gets ignored. So it's about zooming out and looking at that big picture. What's your ultimate goal? What's your long-term goal? Does the lender I'm going with tie with what I'm wanting to achieve ultimately? Because for most people, right, the goal is financial security, stability, control in their lives. And if you're stuck because of the wrong lender and loyalty to the wrong lender, then, it's a massive personal opportunity cost to your family and yourself.
That's right, because finance is what fuels a property portfolio. And if you could get that right, then you could progress and, I guess, make more money along the way. So you need to look at the big picture rather than small little details.
It's not even about the property itself. Ultimately, it's about the finance you're able to get access to. So building a property portfolio is really strategic lender selection and going to lenders in a specific order. The first thing is looking at which lenders you can maximize that opportunity with. And you move generally from more conservative to more convenient or more lenient lenders. So moving from bank to non-bank lenders. Then there's valuation shopping.
Yep. So valuation shopping is an important part of you expanding your property portfolio, where you look to maximize your borrowing capacity depending on where you can get the highest value for your property. So you tap into higher equity. And that leads into how much equity is a lender willing to give to you. Some lenders would control the money, others would release that equity to you. The idea is that you want maximum control of your cash.
Yep. And then whilst building a portfolio, it's also important to consider your repayment types, right? Whether you're paying principal and interest or interest only, considering the tax benefits subject to your tax accountant advice, and what helps you reverse compound paying of your owner-occupied property, right? Ultimately, it's a game of finance. It's not just property selection. It's about how you're setting that up.
That's right. Making sure that you have accurate or correct repayment types for the type of lending you have, and also how it ties in with your long-term goals. Don't just pick a repayment type because, well, you'll save on interest, for example, under principal and interest repayments versus interest only. It could it could help you move forward with your goals faster, potentially pay off your owner-occupied, non-deductible debt faster as well. As a result, minimize risk and maximize tax efficiency
as you move along your portfolio. I think what people need to remember is what you can do today may not be the same what you can do in the future, because lending climates change at all times, right? Your life circumstances could change. Valuations of your properties could change. Often people are like, well, we'll do it later. But no, the banks are not waiting for you. The economy is not waiting for you. Property markets move. And worse, you may not be able to do the same what you're able to do today.
That's right. So a few years ago, I was assisting someone. I put a strategy together for them. They were with a lender, and there was no need to move lenders to another lender because they had paid lenders' mortgage insurance. And at that point in time, this person unfortunately got really disappointed that the valuation of their home wasn't in line with their expectations. They thought the valuation should have been here, but the valuation was here.
But they could still expand, though,
Yeah,
right?
they could have still tapped into the equity and bought another property. This was something like 3 to 4 years ago. And in this time, they would have had hundreds of thousands of dollars in capital gains. But they got concerned and they were really disappointed that why hasn't the valuation stacked up? But the idea is you do what you can with the resources you have at that point in time.
But then there's also the flip side, right? Here you said that they did not have to refinance, but we've also seen people where they've paid, say, lender's mortgage insurance and their broker or banker has just refinanced them when they were just good where they were. So don't refinance for the sake of it as well. Look at it, step back, look at your portfolio, what's possible. Yes, valuation shopping could help you move forward, but also look at where you are in this situation as well.
And that's right. So taking action with what you have and not being disappointed because this is all you can do today. Like lending climates evolve over a period of time. What you can do today may be very different to what you can do a year, 2 years later, for better or worse. If lending loosens up, you may be able to expand your portfolio further. Or if lending tightens, and you may not be able to do what you're able to do today. So take action where you are with what you have. So we don't know about the future. Just make the most of what's there.
In this episode, we discuss your income, liabilities, and your expenses and how banks take these. We also shed light on lender policy versus low interest rates. And we also talked about strategic lender selection as you build your property portfolio. Thank you for listening. Join us another time for another episode of Property Addicts Australia podcast.